All right, well, good afternoon, everyone. My name is Greg Klein from Hayes Financial Group, and thank you for joining me on this presentation. We got a fascinating, timely subject that we got prepared for you today that we'll go through. And we're recording this, so as always, use that chat box to send in questions, and we'll get to your questions at the end. We'll post the recording on our website, so you have our website on this title page. We're always here to help, so you can scan that QR code that's on the screen. That's a way to get to our scheduling page. If you ever want to schedule time to speak with us, we're available at any time for you. Another way to know what we're up to is with our LinkedIn page. That's on the slide, and we'll give it all to you again at the end of the presentation. But let's take a look first and see what we have in store for our material today. So here you see our objectives for the next roughly 40 minutes. This morning it took about 40 minutes to get through the material. So we'll start with a little bit about the what. We'll kind of set the scene, introduce some of the educational information, help us gain a better idea of what inflation is, why it's been in the press, and then we'll really get to that why to understand, why it's important, how it affects you, and then cover some tips at combating inflation. And as I mentioned just a moment ago, we want to keep the conversation going. So we'll leave you with all of our contact information for Hayes Financial Group so that you can reach us at any time. So we've got a pretty packed agenda and for the time that we have together. So we'll go ahead and get started. And the first thing that we'll cover is the definition of inflation. It's a good place to start. Most of you, I should say, probably have a pretty good idea of what inflation is. And I guarantee that all of you have experienced it in some capacity. But essentially, inflation, it's a reduction in your purchasing power. So it's that idea that your dollar buys less today than it did years or decades ago. So we see the loss of purchasing power and higher prices for goods and services that we use all the time as consumers. And then there's a bit of a tug of war with inflation. So you have a pull. So us as consumers, we kind of pull with demand. So, if we, like when we come out of the pandemic, we have increased demand that can cause some inflation, cause prices to rise. And then there's also that push from suppliers. So if their costs are higher, they might push some of those higher costs to us as consumers. And so this push-pull. And we'll see a lot of that in the material that we'll cover today about what's going on with inflation in the economy. But that pulling of prices, so from increased demand, consumer demand, that can be a good thing. And that can actually be a sign that the economy is expanding. So that kind of begs the question then, is inflation always a bad thing? And that's the next topic that we'll touch on. It's just like most things in life, inflation is okay in moderation. So a slow, steady increasing of prices, it prevents what economists call the paradox of thrift. That's that idea, if you think about it, that if you know prices are going up, you're less likely to just sit on your money, do nothing with it. You're more likely to spend it or invest it to make it grow as fast as the rising cost of living. Now, the opposite of inflation is deflation, and that's where prices are falling. And that can actually lead to worse economic conditions because there's not that incentive to spend. If we know prices are going down, then we're kind of incentivized just to sit on our money. So a little bit of inflation is not always bad. The Federal Reserve, or the central bank of the US, that we'll talk about a lot, and you'll be hearing in the press, they've been in the press quite a bit the past couple of days, but they have really two responsibilities. One is to moderate inflation, and the other is to keep the economy fully employed, to maintain full employment. And so with one of their duties to moderate inflation, their target is to have inflation at 2%. So it's not at zero. So don't think that any slightest bit of inflation is always bad. The central bank does want a little bit of inflation. But with that said, what we'll see in this presentation is that what we've been experiencing lately is above that 2% target. So that may be some cause for concern, and and a bit of the reason why we've seen it in the headlines. But how is it measured? That's the next thing. So what we'll refer to is the CPI, or the Consumer Price Index. That's the most common measure for inflation. And that CPI tracks a basket of consumer goods and services. And so this is stuff that we do and consume, and they track this over time to see if it's trending up or down. And a lot of times when you hear this CPI, or this Consumer Price Index, reported, you'll hear a couple of different numbers. They might split it into two different numbers. They might say the headline number, which is the raw overall inflation, and then they might also talk about that core number. And the core number, it excludes two parts. It excludes food and fuel, or food and energy, and those are that's because those areas are more volatile. They move around a lot more. So when you hear inflation, you might hear it referred to as the headline number, and then the core number takes out gas, what we pay at the pump, and then food, what we pay at the grocery store. So we're moving along. We talked about how we wanted to set the table here and understand a little bit about what inflation is, how it's measured. So now we'll start to get into some of those charts and graphs and see what the situation's been lately with inflation. That CPI that I mentioned, that most common measure for inflation, and then again the core CPI, which is without food and fuel, you'll see that in this chart. So you'll see the blue line is that headline number, or the overall inflation, and then there's a darker line that is the core number without food and fuel. And you can see in this chart that the blue line, it moves around a bit more. It's a little bit more erratic, so that headline number is a little bit more volatile with inflation. Then when they take out a couple of those things that move around a lot, like food and fuel, then you'll see the core number is a little bit more stable. But what we've been experiencing with this kind of, I don't even want to call it a post-pandemic, but it's like, kind of coming out of the worst part of the pandemic, the surge in consumer spending, pent-up demand. People wanted to get back to normal, spend money, have higher oil prices. We'll see information on what's happening with the supply chain. This has created this inflationary environment. And so now inflation, as you can see in this chart, it's above that 2% target. So we see in September that headline number, so overall inflation was 5.4% compared to last year. And then current concerns have been exacerbated even more in October. You see that headline number 6.2, so way above that 2% target. And that 6.2 number that was in the news quite a bit for October, that's because that's the fastest growth in prices. So the most inflation that we've seen year over year since like the early 90s. You take out the food and energy, you look at just that core number, is still 4.6 in October. So like I said, it's been driven a lot by the reopening of sectors of the economy, higher energy, food costs, and so a bit of broadening of inflation, including things like used and new cars. So inflation is up. It's not, as you can see in this chart, like it was in the 70s or early 80s, but up higher than it's been for quite a while. So let's look a little bit closer at some of those components of the CPI. I said the CPI is that basket of goods and services. And so let's look a little bit closer at some of those different parts of CPI. And these components, they've been the ones that you see on the chart for sure have been up lately. So we have energy first up in the top left. But oil prices, like I mentioned, they are very volatile. So while it's been up coming out of the pandemic a bit, you may have heard the news that just before Thanksgiving, more of a political move probably than anything, but there were 50 million barrels of oil released from our U.S. Strategic Petroleum Reserve, to try to deal with some of the higher oil prices. But then you got things that we're dealing with now with this new variant, travel restrictions. So while oil and gas has been up, then just earlier this week on Monday, it dropped about 4%. So you get a feel for why they take that out when they report that core inflation number, because fuel can be very volatile. Same way food. Thanksgiving was more expensive this year. They said, the Thanksgiving feast was up about 14%, turkey, was a big part of that, up about 18%. But if you use gas to drive to grandma's house for the holiday, that was more expensive. Your Thanksgiving feast is more expensive. If you drove there in a car that you bought recently, you're probably well aware that part of the shortage and supply of things like semiconductors that's impacted car prices. And so you see all these different components, they ripple through this overarching measure of inflation, the consumer price index, the CPI. And then some have even more of an impact on that number. And we'll see those next. This chart's from this summer, so it's a few months old, but it does show how some of those components like gas, like used cars, make up quite a bit of those inflation gains that we've been seeing. But of course, for every action, there's a reaction. So, in a market system, you have higher prices that might bring on more supply and then lower the prices. And that's kind of the basis behind this argument that inflation might be a little bit more short-lived or transitory. And this has happened in some industries, not all. I think if you remember back to just before, like this chart was put together, like springtime, at that time, what was grabbing the headlines was the high price of lumber. Lumber, after initially surging, that's come back to a little bit more trend levels. So inflation in some areas can be more short-lived, more transitory. You'll see that inflation, as we get through this presentation, is a very nuanced topic. But what with lumber, cars, like I mentioned, semiconductors, supply issues are also factoring in. The slide looks at how things are slower. So on the left-hand side, global suppliers, how it's taking longer with these delays, these bottlenecks. You've probably seen stories about all these container ships, sitting off the coast of California. In this chart, you have that level line that's at 50, and then anything above that means it's taking longer. So you can see there's quite an uptick, and delivery times are much longer or slower than average. And then on the right, we see input and output prices. And so that's important to inflation, because if a producer, if what they use to produce their good, if the price of that is higher, well, then you see the correlation on this chart between input and output prices. A lot of times if their inputs are more, then they don't have much of a choice but to pass on those higher costs to you as a consumer. And so the recovery, there's been some pent-up demand coming out of the worst part of the pandemic. And so we've seen that demand increase as people want to get back to normal, maybe spend some of that money that they weren't able to spend during the worst part of it during the lockdown. But with this chart, we see that the supply side, so demand is high, supply is constrained and trying to keep up. But it's not as easy as flipping a switch and getting everything back to normal. And so you have these backlogs, that can lead to these higher input prices, and where there's this disconnect between supply and demand, that's where we see inflation creep into the picture. But as I mentioned, inflation is very nuanced. It's not felt the same across the board. And so we're painting this inflation picture in this first segment of the presentation, and you're picking up on that fact that it's not super cut and dry, and inflation, like I mentioned, it's not universally bad. There is a target for a little bit of inflation. It's when it gets to be too high that it's a concern. Different sectors experience this differently. And then we also live in a big country geographically, and you can see this is a chart from the Wall Street Journal, kind of a heat map, where they showed, year over year where inflation is worse and what parts of the country. You can see the Great Plains into the Southwest. It's worse than other parts of like the East and especially the Northeast. So it's not, the same across the board when we're looking at the story of inflation. And inflation, it impacts our expectations of the future. And one of those expectations is wages. So inflation combined with wage growth, that can create sort of a spiral dynamic where workers, they want higher wages to compensate for, what they expect to be more inflation and losses in their purchasing power. And as they demand higher wages, that increases the cost of production. Then that's passed along. Those are inputs. Wage is an input, and then that's passed along to higher prices to us consumers. Unless if they're able to offset some of those costs with productivity gains, or think of, like a kiosk. If maybe rather than employing a human, you might go and order your food at the restaurant from a kiosk. That might be a way that they're able to control the costs and not pass on higher costs to you and exacerbate inflation. Or recently here where I am in Minneapolis, there was a story about a restaurant that bought a robotic waiter. Those are productivity gains, but short of those productivity gains, then there's that spiral and it becomes a little self-sustaining. Wages go up, that's higher inputs, higher prices that are passed along to us as the consumer. So I've referred to this as the Great Resignation. There's been a shortage of labor supply, so a shortage of workers, but the demand is there. Remember, there are lots of companies looking for workers. You see those help wanted signs everywhere. But there's a lot of factors into this. Those prolonged and enhanced unemployment benefits, continued fear of the virus, school closings, lack of childcare, early retirements, people that just got out of the workforce early, maybe during the worst of the pandemic and aren't going back, a drop in immigration. All these things factor in, but the demand is there again. So there's a supply demand disconnect. There's the demand, people are looking for workers, but maybe not all the workers are there to fill those jobs, or they're not willing to go back. So we see that demand outpacing the supply. And if employers can't keep up and deliver the experiences and customer service that we previously enjoyed as consumers, then that ties into a bit to our next topic, which are some slyer forms, or I say more, insidious types of inflation, but still inflation, stuff that we all experience as consumers. And you've probably heard of the first one that I listed there, shrinkflation. That's when the price stays the same, but the amount that you get goes down. So the example that I think of is that dimple in the bottom of your peanut butter jar. They always talk about that dimple getting a little bit bigger, so there's less peanut butter in your jar, but the price stays the same. That's that idea of shrinkflation. What's been coined as part of the Great Resignation, so a lot of people not returning to the workforce, that disconnect between labor supply and demand, is this idea of skimpflation, so a decline in service quality. So where we're paying the same or more, maybe a little bit more for our services, but we're not getting the same service that we used to. So think of if these companies are skimping a little bit, not willing to pay more yet to hire on more workers, then you might see a little bit less in terms of service. You might wait a little bit longer in line at a restaurant, bar, or hotel because they're understaffed and stretched kind of thin. Food is taking longer to get to you. If you call a customer service line, you might be on hold for much longer. So businesses are struggling, especially small businesses, to cope with some of these surging input costs, this disconnect between labor supply and demand. And some of those businesses, they might not be able to pay more to recruit more workers or invest in those productivity gains through technology. So what happens is a little bit of that skimpflation. We might pay the same and just be getting less for our money. But we got to cut everybody some slack. We understand that, like everything in the world right now, it all really comes back down to the pandemic. And it's a slow adjustment, getting back to normal, where demand and supply are disconnected. And it's affecting our everyday lives. If you're not experiencing it with hard financial numbers in terms of inflation, you can probably relate to something like shrinkflation or skimpflation, where this loss of purchasing power, affects us in so many different ways. So if we kind of look back with the story of inflation, what's taking place now, then we're going to transition and talk a little bit about looking ahead, how to deal with inflation. And this hotly debated question about inflation, it's been how long will it last? Will it be more short-term, transitory, or will it be longer term and be a little bit stickier? Transitory meaning that, these things, these kinks will work themselves out and it'll go back to like longer term averages. And that was the story. The Fed, the central bank, was saying that pressures were expected to be temporary and was promoting the fact that they thought inflation would be more transitory. But Jerome Powell, the chairman of the Federal Reserve, he recently talked about how these inflation pressures will push well into next year. And just yesterday, as he was testifying before the Senate, I know he's testifying before the House today, and I didn't hear anything about what he said so far today, but yesterday I know he said that these price increases, they've spread more broadly in the last few months, and they think that the risk of higher inflation has increased. So you see these views are moving increasingly away from that very short-term transitory idea, and maybe inflation's going to be a little bit stickier. It might moderate in the next few months, but those wage pressures and things like that, comments that we're hearing out of the central bank, the Federal Reserve, it might not. But if we look at this chart, this shows three things. I mean, it shows forecasters, what forecasters predict for inflation, how that correlates pretty closely to what inflation ended up being in the future. But what I want to draw your attention to is that kind of like light blue line that's up at the top, because that's our consumer expectations of inflation. And you'll see that they're consistently higher up. And so that's that our human behavior, our human nature, wanting to magnify things a little bit more. And so I just point this out just as a reminder that we're only human, and we tend to think that things are worse than they actually are. So is inflation rising? Yes, it's certainly something to be concerned about, but we also need to accept that it might not be as bad as we're assuming or as bad as we're seeing, based on these headlines that we see just to catch our attention. So understand that we as humans and consumers, we tend to expect the worst and magnify things a little bit. These are those Fed predictions. Like I said, they've kind of been in the camp of it being more short-term, transitory. They're changing their tune a little bit, especially based on that quote that we saw from the chairman yesterday. But the Fed, they're never going to admit that they're wrong. I've heard it say that the Fed, they're kind of like meteorologists. They don't make mistakes, so they don't get it wrong. They just make inaccurate predictions. So they'll just say, their predictions were off, but not that they were actually wrong. So we always have to take their predictions with a pretty hefty grain of salt. So, what we've seen the Federal Reserve do is keep inflation down over the last 18 months, especially. They've been flooding the market with money. They've been buying bonds. So they've been buying $120 billion of bonds each month. That keeps interest rates low, makes money cheap. But now they're going to taper back that bond buying. So you hear that referred to in the press as this idea of tapering. So they're going to buy fewer bonds. It means they're going to push less money out into the system. And they announced they're going to be buying 15 billion less each month, and that may accelerate. But they expect to increase interest rates next year, and even multiple times into 2023, 2024, to follow these projections. So they say, for 2021, yep, inflation was up, but they anticipate with their moves that it'll moderate, and in the next few years get closer to that long-term goal of 2%. To be continued for sure. So as we always say, hope for the best, but be prepared. So we'll transition then into how this affects you as a saver, an investor. We've learned a lot about inflation, what it is, why we should be concerned about it. But how this affects you is, again, it eats away at your purchasing power, and then also with your investment returns. So if you think of the return that you see with your investment, say it's 10%, they refer to that as your nominal rate of return. Well, you made 10%, but if inflation is going up at 3%, you subtract that out, and then the remainder, that 7%, that would be called your real return. So that's your actual increase in purchasing power that you're getting from that investment. So it looks like you made 10%, but if you factor in inflation, your real return is actually 7. So we also want you to understand that concept of real return, because if inflation is rising faster than the return that you're making, you're losing purchasing power, even if the return that you get is positive. Take this example. This shows us the 10-year treasury, or the federal government debt instrument that they consider a risk-free investment benchmark. They say, this is basically, if you want a risk-free investment, this is where you put your money. And this chart shows it going back to the 50s. You can see what rates have been. Now they're around 1.5%, say 1.4, 1.6, but that's in those nominal terms. So nominally, they're above zero. Factor in inflation, and now we see down we're in that negative real yield territory. So to take zero risk, you think, I'm making 1.5%, but if you factor in inflation, you're actually losing purchasing power and your real return is negative. So this is that risk-free investment, or that risk-free benchmark. If we put our money there, right now we're getting a negative real return. Well, as investors, we're going to have to take on more risk than zero to make sure that we get a positive real return. And so again, if we look way back, decades back, all the way back to just after World War II, we can see how that real return has been better for those higher risk types of investments. So you see large company stocks, small company stocks, how much more they've had in terms of real return versus inflation and those risk-free investments, like a treasury investment, like the T-bill. And we zoom in a little bit more. So this is many, many decades. But you see that those investments, there's a little bit more risk, but for that risk, they provide you additional real return. Here we can look at 20 years of annualized returns. So the last 20 years, these different asset classes, but same story. So you see higher risk asset classes, so like real estate, international investments, you see their emerging markets, large company, small company investments. Their return over inflation, which during this period was 2.1%. So they're providing much more real return. Now, if we look at what the average investor did, you see that little stick figure there that returned 2.9% on average each year. Not much of a real return, not a whole lot above inflation. And that's because of our own actions. So as average investor, we hear about things like inflation. We see a little bit more volatility in the market. We get spooked. We make decisions that hurt us over the long term. And that's why you see that the average investor gets hurt. And that is really the reason why we bring this material to you. We want you to understand that we're always here for you, because we don't want you to fall into that trap. We don't want you to be average. We don't want you to make those decisions that are going to hurt you over the long term. Inflation is definitely a growing concern. But as retirement savers and investors, not understanding inflation, can and how it affects our savings and our portfolio can make us take horrific decisions that'll negatively impact our performance and the likelihood that we're going to achieve our retirement savings goals. So that's why we want you to know that we're always here for you. And then, once you do get to retirement, inflation continues to be a factor. Here we see how inflation can mean the difference of years less of retirement income. So this person, they'd have $500,000 in retirement savings. They're going to take out 5% a year, so $25,000. And then what they're going to do is they're going to target that $25,000 and increase that every year by inflation. And what you see is by that 5% withdrawal rate, they're in pretty good shape. They're in that light gray shaded area between 20 and 30 years of retirement income. With most of these portfolios, certainly the stock portfolio, the portfolio that's 60% stock, 40% bonds, and then the 40% stock, 60% bond portfolio. But as that inflation gets higher, so that blue bar where inflation's up more like 6%, we see how that can put them in a situation where now maybe their retirement savings won't last throughout their 20 plus years of retirement. So understanding how it impacts you allows you to make wise decisions, make decisions today, understand there's a reason why, yeah, maybe we don't have a 100% stock portfolio, but we do want to have some investments that will provide us that real return to make sure that our money is growing, that we're gaining purchasing power, and that our money is going to last throughout our retirement. And so this shows really, how inflation can impact your nest egg in a lower inflationary environment. Most of these people are okay. It gets up there into that 6%, and then we start to get into a little bit of trouble. So maybe if inflation's going up, then your nest egg needs to be a little bit bigger, or you need to have appropriate asset allocation with your money to make sure that it lasts throughout your lifetime. And then our final segment, we'll see what we can do with our investments in retirement to counteract inflation. And I say we can, shorten the duration. So when you think of if there's inflation and interest rates are rising, and I couldn't avoid, the opportunity to reference a Styx song with Too Much Time on My Hands. So you got too much time on your hands. If interest rates are going up, that can cause you maybe to consider underweighting those bonds, because as interest rates go up, the price of bonds go down, or those bonds that you want to have a shorter duration so that you're not exposed to that inflation risk. Doesn't mean ignore bonds. It just means the bonds are still there to protect your capital, hedge risk, lower your volatility. So they're serving a purpose, but maybe you don't want to be as long with the bonds that you're investing in. Kind of the same holds true with stocks. Higher interest rates. Like I said, the Federal Reserve is not going to be flooding the economy with as much cheap money. So it's not as easy to be a speculator. It's going to be more expensive. If interest rates go up, it's going to cost you more to speculate. So maybe those companies that have the strong fundamentals, free cash flow, if they have that free cash flow, they can pay that to you as an investor in the form of dividends. Those are things that maybe attract you if you're really concerned about an increasingly inflationary environment. And don't forget about those dividends. Stocks. So when you're investing in the stock market, stocks not only have capital appreciation, so that increase in the price per share, but they can also pay dividends. So they can take cash, profits that they have, and pay it back to you as an investor. And this chart just shows over a long period of time, how much those dividends account for your stock gains. So in inflationary periods, don't sleep on the stocks that pay dividends as well. But you might have investments in your 401k or 403b where it's even more obvious. So, if thinking about shortening your duration, trying to pay attention to things like dividends, maybe that's a little out of your or above, your level of understanding with your investments. But a lot of 401k, 403b plans do have investments that spell it right out for you. You might have an investment available in your plan that has, you see this little word cloud, it might say something like TIPS or inflation protected, meaning it's going to invest your money in what they call Treasury inflation protected securities, or TIPS. So these are, again, federal government bonds that are designed to provide you real return. So the principal value of the TIPS, rises as inflation rises. So the interest payments, they vary and are adjusted, with that principal value of the bond. So they're guaranteed to outpace inflation. So they're designed to give you that real return over and above inflation. And you might own some of these. You might already have an investment like that available to you. So that's another option. Make sure you're maintaining enough stocks, in your portfolio. As we saw earlier on, the stocks are one of those investments that are going to provide you, yes, they will have additional risks associated with them, but they'll provide you that real return and help avoid that longevity risk that you're going to outlive your money. And we saw how some average investors get hurt because in a period of inflation and interest rates going up, the market, and we've seen that over the past few days for sure, that the market's been moving around a lot more. So it might be more volatile. So you might have to, strap in and just get ready for the ride, but understand the reason why you're exposed to some of those stock investments is to give you that real return over and above inflation. If you understand that, you might not be susceptible to making those decisions that hurt your portfolio over the long term, like so many investors do. Because a safe investment, after all, we're looking at real returns. Now that you understand inflation and real returns better, you understand why a safe investment, it might not truly be as safe as you thought it was. Like take just putting money under your mattress. If you put money under your mattress, now you realize that inflation eats away at your purchasing power. And so while the number of dollars you still have under your mattress, but when you go and pull those out 20 years in the future, they're not going to buy as much. So they're not worth as much as they were 20 years in the past. Or that investment that's a cash type of investment that's paying you, a steady rate, maybe 1.5% around there, like those treasury, 10-year treasuries, they're like around 1.5%, but we see subtract out inflation, and now their real return is negative. So that safe investment might not be as safe as you thought, because it's not actually providing the real return. That's again why we have that diversification, and we put up with those ups and downs in the market. But those are really just short-term ups and downs. We see that in this slide that it shows historical periods, stocks, bonds, and then a 50-50 portfolio. And you see that if you go beyond 1 year, those 5, 10-year, 20-year periods, the probability of being down over that period of time is very low or non-existent. Even for the 100% stock portfolio, it's really just those short periods of time. So like those single years where the market can be up a lot, but it can be down as well. So understand that having that stock exposure, you have to put up with some of those short-term bumps to be able to benefit from that real return that you get over the long term. And understand your time horizon. How much time do you have before you're going to need to access this money? And that's super important. But diversification, you can always benefit from diversifying. Look at what we went through last year in the peak of the pandemic, those really tumultuous couple of months in the spring of 2020. You can see 3 different portfolios in this chart. It shows the 40-60, so the least risky, only 40% stocks, 60-40, and then 100% stocks. And of course, the 100% stock portfolio fell down to the lowest in March 23rd, and then took the longest to recover. So that diversification, those other portfolios that mixed in some lower risk investments with the stocks, didn't drop as much, recovered quicker. Now, further on down the road, you see the stock portfolio has recovered and has bigger gains. But you understand that idea of diversification, that it can reduce the downs, recover quicker. Your highs might not be so high, but your lows won't be so low. So diversification is always a good thing. If you're not diversified abroad, that's another thing to consider. Higher inflation, interest rates as they go up. So the Federal Reserve is saying they're going to raise interest rates as interest rates go up. Typically, that means the dollar will be weaker. So if the dollar's weaker, the dollar's not buying as much, maybe those profits abroad in foreign currency are worth more. So having some exposure internationally, investing globally is also a good thing. Make sure you're diversified not only in the US, but abroad. And again, if you're not able to do that on your own, your retirement plan at work is going to have easy options that will do it for you. So having that appropriate asset allocation, hedging against things like inflation, incorporating those investments like stocks, real estate, even those treasury inflation protected securities, that can be done for you in something like a target date fund or a risk-based portfolio that you have available in your employer sponsored plan. So if you pick one of these investments, there are experts managing your money, and they're going to have an appropriate risk for you, taking into consideration all these different factors, including inflation. So that's a really easy way that you can invest in your 401k, 403b, and then take advantage of the match. If your employer offers any match in the 401k, 403b, don't pass that up. Here we are, we've just spent 40 minutes talking about inflation and inflation being high at maybe 4 to 6%. But if you're worried about 4 to 6% inflation and you're passing up a guaranteed return, a match of 25, 50, 100% in your employer plan, I mean, then we need to have a little bit of a chat, because taking advantage of that match, puts you way ahead of inflation right there. So don't miss out on the match, whatever you do. Take advantage of the employer match, take advantage of those easy to use investment options. And then finally, if you're approaching retirement, you're maybe maximizing your Social Security payments, maybe not taking Social Security as early as you're tempted to do, because Social Security has built-in inflation protection. So Social Security every year gets a cost of living adjustment. They call it that COLA. And for next year, the increase for Social Security is 5.9%. So it's adjusting with inflation. So that's another thing that you can do as a retiree to combat inflation, is make sure that you're getting the most out of your monthly Social Security benefit, because that's a stream of income that's going to automatically adjust for inflation, and make sure that you're keeping up with inflation. And so let's revisit our objectives. I'll give you a little confetti, and congratulations that you made it this far. I think we ticked all the boxes, gained a better understanding of inflation, what's going on, why it matters, some simple steps like portfolios, target date funds, taking advantage of the match, having that appropriate asset allocation, exposure to investments that'll give you real returns above inflation, maximize those inflation adjusted options like Social Security. Lots of things that you can do to put you more at ease if you're worried about, as we enter in a more inflationary period. And then we're here for you. So reach out at our website. You can follow us on LinkedIn. You got my email address, our phone number. You can text us at the 833 number. Pull out your smartphone, scan that code. That gets you to our scheduling page where you can put time on our calendar whenever it's most convenient for you. And we're always here for you.